now we turn to China and, and Asia in general. And I think it's important to look at the global textiles market because I think this is really interesting. And you could see that even though companies started moving some of the manufacturing as early as 2014, really kind of accelerating a bit in 2018. You saw a lot of that go into Vietnam, Bangladesh, India, Pakistan. But China's still massive. It's still a $275 billion market. So there's still more to pivot out of China. And that's when we start looking at that nearshoring, onshoring. And one of the beneficiaries of it has been Mexico, has been some of these other nations. And a combination of that supply chain chaos and higher costs and concerns about working conditions is forcing the Western brands to rethink the reliance on China. And that's when we've been talking about this for a long time, where you've seen some of these shifts. Now, as we see some of the additional movements, and the big message is reducing reliance on China. And then as we said, we can try to find the show that we said it in 2020, where what was the quote that I had used? I had said, if you haven't moved out of China yet, it's already too late, but not late enough not to try or start. And so one of the things that and this was before even COVID lockdowns hit full bore, because we were like, look, you should have been diversifying. We had been calling for it throughout 2019. I had actually done a research report, went to graduate college in 2006, where I said that globalization was going to peak in 2016, and you were going to start seeing some of those more aggressive pivots by 2016 onward. Instead, it was closer to 2018, but by no means to the rate I expected. And then the kind of blow off top was that where people finally recognized, oh my God, I'm overexposed, was obviously COVID, when people recognized how just fragile their supply chain was. And you still see reverberating issues because of that. But this is a long-term headwind for China. And I have a chart in here that's going to show you cost of a Chinese worker versus Asia, the rest of Asia. And a Chinese worker is very expensive versus Vietnamese, Bangladesh, and Indian. So it's like, well, what's the impetus to stay? And not to say, and again, this is by no means by saying that, Nike's going to come in and say, well, we have 5 factories in China, shut them all down. No, China is still a gigantic market. It's not like you're going to shut down all 5, but do you need 5? Does 5 go to 3? Does 5 go to 2? And then you build an additional one in India, Turkey, Pakistan, Cambodia, and that is a headwind for China, which is actually going to have one of the largest classes of new employees, I think it's on record, or at least top 5, which is going to create problems on unemployment as you get more jobs leaving. And that's a problem, especially when you consider total local government financial vehicle and the debt levels. Look at how much that debt has risen over that period, where even from 2016 to today, you're looking at it almost, actually it doubled in 5 years, 6 years. You've seen this massive shift, which is a big problem when you look at both bonds and loans, because the government is saying you need to ease, you need to invest in infrastructure, but that's blown out spreads, because it's like, well, okay, what are you investing in exactly? Like, what is the cash flow and capacity of it? And so the PBoC maintained prime rates. And there's some leaking in terms of the PBoC, but China's central bank has told some banks to slow the pace of lending to contain risks after new bank loans jumped to a record in January. The PBoC sent the informal instruction, or the so-called window guidance, earlier this month to some lenders that asked them to issue loans under an appropriate growth rate. So when you think about, the banks were told to control the scale of new loans in February to avoid issuing new loans at a too rapid pace. They were also said to if banks are blindly pursuing the increase in the scale of loans, they may not be sustainable. Shocker. They also asked that the loan growth was mainly underpinned by state-backed infrastructure projects while actual business demand remained weak. They're investing in infrastructure that has already had a negative growth rate in terms of the multiplier impact. That's, again, what is the benefit at this point? Because now it's going to you're throwing good money after bad, increasing risk, increasing pressure, and that's where we see additional risk. And they've actually told banks that if you've done a lot of loans, put them on your books at different months to try to extend some of this. So again, you're seeing a lot of this pressure. But now looking at sales manager growth in general, you had a reopening. Things were pretty good. But if you look at, again, market growth, it's still negative. When you look at staffing, not quite positive. Profit margins flatlining. So sales and confidence have gotten a bit better, but you're still not seeing this big, gigantic reopening trade. And this is the longer term headwind, the manufacturing unit labor cost. When you look at China, $8 per hour, or just over $8, versus the Philippines, Malaysia, Thailand, India, Vietnam, anywhere between $2 to $3. So that's a lot of money when you think about it on volume and scale. Now, made in China is no longer that cheapest option. And China's also got that unemployment problem. As we said, that's because 7 to 8 million of the record-setting 11.5 million university students graduating this year will enter the job market in 2023. Combined with still jobless graduates from the previous year, a total of 14 million recent graduates could be seeking employment. The economy, again, typically 1% of GDP growth supports about 2 million new jobs. So GDP growth coming in at 3 to 4% is a problem. Even 5 to 6%, 10 to 12 million jobs. That's and that's with the headwinds that we've been talking about with nearshoring, onshoring, this shift, and the inability to continue dumping infrastructure spending into the market, and again, trying to drum up economic growth, but at what cost? And that's what the PBoC is alluding to. The law of diminishing returns is real, and it's becoming a bigger problem. Wall of maturities for local governments. Local governments also have to pay back their debt or roll that debt. While their leverage ratios are going up, spreads are increasing, so the cost is going up. So not only were they tasked by the CCP to issue more debt, which the PBoC quietly said, please don't. You also have this back and forth in terms of where rates are going, which is why there's this view that it's like, oh, well, it's all local currency. It's like, but it's not, because a lot of these are also tied to multinational corporations. They've invested in Belt and Road Initiative programs. They're invested in global markets. They have other, even if this debt is in renminbi, they have other debt in dollars, which is going to, again, there's going to be a correlation between the two. And if the spreads are blowing out in renminbi, I can assure you they're no cheaper in dollars. And that's, again, the pressure point that we continue to see, which is why the government debt is such an issue, and especially the maturities. Instead of having just under 1 trillion renminbi, we now have almost 4 trillion renminbi local government bonds maturing. That is a problem, while they're also being asked by the CCP to increase loan growth. It's why we see so many problems and issues in China, why the reopening is going to disappoint, why there's not going to be economic growth that's expected. You can kick the can only so far. And one of the running jokes back in 2011 was the can is light and the foot is strong, which means you can kick that can far. And my pushback was true until you're kicking it into a brick wall. And no matter how strong that foot is, how light that can is, there's nowhere to go. And my whole point were two pieces. One, your debt levels, and which would then be leverage ratios, which then would create who's your buyer of last resort. At some point, nobody wants your garbage paper. Nobody. And that becomes the underlying problem, which is who is your buyer of last resort. Now, when you look at China new home prices coming in flat, well, that's okay, but look at property sale prices. And this is the biggest issue, because until the consumer sees a meaningful increase in their portfolio, there's no buying. So they're going to have to keep trying to use infrastructure spending, new bonds, but to what degree, what efficacy, and that's where we have more problems. Now, on a positive note, foreign direct investment was good. And this is something where was some of it pulled forward, because if you look at December, foreign direct investment was fairly weak. So you could say that, well, there was a certain makeup because you had the reopening. So I think that February is going to be important to see, do we get a continuous move, or is it something where it just goes sideways? We think that long-term, back to the view of nearshoring, onshoring, that FDI is going to come down, which is something that Xi has talked about, trying to get in front of and influence, trying to get people to stay and invest more in China. Now, Japan Service PPI expected at 1.5%, came in at 1.6%, but the Bank of Japan announced an emergency bond buying operation last night because the 10-year breached the ceiling. That is showing, again, if Japan can't maintain the pricing level, they're going to have to raise rates. And that's why the reassessing BOJ's paths, and now most economists, shocker I know, expect tightening this year under Udi's leadership. And that's where we see that there is going to be, and what we think is a more aggressive rate hike even than what is expected in the market. Given the path that they're taking, they have to try to kick that can as long as they can to get to the other side where exports get better and things start to turn around. India's GDP nowcast has shrunk. The GDP growth has come under pressure. It's still growing, but at a slower rate. And we see more pressure to the downside and even slightly negative, driven by the debt load that they have, the budget deficit, and inflation, which is going to weigh on some of that growth. We thought it was going to happen sooner. Clearly, we were wrong, but the trend is still there, and that's going to pull down some of that global growth, which is why we still think the IMF is overstated. Manufacturing PMI in Japan came in at close to 45 in general. Service PMI came in better, coming in closer to about 43. So you're still getting that difference between manufacturing and service, and that's where there's some of that is going to continue to push the BOJ to raise those rates. Now, some of the pressure points on some of the other pieces is South Korean consumer confidence. You can see it's at 90.2, and as we've said, it's going to remain a bit under pressure here. With Taiwan export orders expected at negative 24, came in at negative 19.3. That's a positive. It's better than estimates, but you can see just when you pull out, how low they still are and why we still think there's a lot of Asian pressure. And especially when you look at Taiwanese export orders, South Korean export orders, Chinese export orders, and Japan, they're still negative. They're still in contraction, and that's something that is going to persist and put additional headwinds, obviously, into the local region, as well as their GDP expectations. So that's what we have for you today. If you have any questions, please let us know. Find us on Twitter, obviously in the comment section, and we hope you enjoy your February break if you have it. If not, if you're getting hit with a snowstorm, hopefully you can go out and play with the kids, because there's going to be a lot of it. So otherwise, we hope you enjoy the rest of your day, and thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.